with the S&P 500 up 25% for 2019, you got to wonder, can we keep climbing into 2020? But you know what? I think that's the wrong approach. Instead of worrying about the whole market, I think you got to be specific, sector-specific, just like I said at the top, because some of them are absolutely positioned to roar next year. And that's why tonight we're going off the charts with the help of Dan Fitzpatrick. He's that terrific technician who's the founder of Stock Market Mentor, as well as being my colleague at realmoney.com, where I blog, to get a better read on the industries that could have serious upside potential next year that, frankly, have been left behind in 2019. In particular, Fitzpatrick likes, get this, the metals and mining, base material, and energy stocks, some of the most cyclical groups imaginable, and some real dogs. When employment's strong, the Fed is your friend, and the global economy is starting to rebound. So maybe these stocks can work. In the last few weeks, we've seen a terrific breakout in the metals and the basic material stocks that has a lot of smart people I know buzzing about how the time is at last right to invest in these down-and-out groups. As for energy, it's lagging behind the others, as you know, but Fitzpatrick's starting to see some signs of life there. If these three groups can continue climbing, well, that gives the bull market a lot more fuel, even though I know that the actual stocks that are left in this cohort aren't that big when it comes to market capitalization anymore. Let's start with the daily chart of the S&P Metals and Mining ETF, and that's called the XME. Now, this group peaked early last year and then promptly fell about 40% before finding a bottom last December at around 25. Remember, that was when the Fed decided it had to change its mind. We've been, and get more bullish, we've been in a synchronized global expansion, which was great for the metals. But then the rest of the world started losing steam, and the U.S. economy got gut punched by the Fed in the fourth quarter, as I just mentioned. And that's why the metals and mining stocks went out of style on the Wall Street fashion show. Just to show you, Fed says they got to keep raising rates. Obviously, things go bad. Then the Fed relents, and then things go higher. That's what you need to know. Since then, Fitzpatrick points out that each rally in the XME has had a lower high, okay? Think about this. Lower high than the previous one. You can see how the ETF's 200-day moving average has been putting a ceiling on it over the past year, and that ceiling tilts down. However, while the highs keep getting lower, the lows were flat. You know what this is called? This is called a flat triangle pattern. Flat triangle pattern. According to Fitzpatrick, when you see this kind of formation within a downtrend, you know it's only a matter of time before something's got to give. Sooner or later, the ceiling comes so close to the floor that a breakout is unavoidable. The question is whether it'll be a breakout to the upside or the downside. So again, let's keep this in mind. As these get narrow, something's got to give. Well, a couple of weeks ago, we got the answer. The XME finally broke out above its 200-day moving average, and it was a decisive move. Suddenly, the old ceiling is now the new floor. And within a few weeks, Fitzpatrick predicts that the shorter-term 50-day moving average will cross above the 200-day moving average. This is what's known as a golden cross, if we get it. And that's the kind of incredibly bullish pattern that technicians just salivate for. Once that happens, well, then the new uptrend will be confirmed. I should say if it happens. I shouldn't say once when it happens, because it still might fail. How about the Materials Select Sector SPDER ETF, the XLB this time? This group's actually been trending higher for most of the year, creating a different kind of flat triangle pattern. See, with the green lines? Well, the XLB made a series of higher lows. Its highs kept running into the same ceiling of resistance at 59. But just like with the metals ETF, when you see a flat triangle, the breakout, as these coordinates kind of, come together, well, something's got to give again. When the XLB's up for the year, it's up, but it hasn't really been keeping pace with the broader S&P 500. But a couple weeks ago, the basic materials ETF finally broke out to the upside. It's currently at $59.62. Fitzpatrick thinks that now it's got a lot more room to run. So we've got the metals and the basic materials, two of the core components of an economic expansion. When these groups are strong, you know that manufacturing is doing better than expected, and there's pricing power for finished goods. We just need one more sector to start working before we can round out the natural resources trifecta. And that's the one that, I dislike so much, energy. Unfortunately, the energy cohort's in worse shape. And you can see that's just not as pretty a picture. I want you to take a look at this is the XLE. All right. The Energy Select Sector Spider, that's the SPDR ETF. Technically, the energy cohort's still stuck in downtrend. Fitzpatrick points out that both the 50-day moving average and the 200-day moving average are trending lower, which means there's not much for the bulls to cheer about here. Every time the energy group tries to rally, it runs into a seemingly unbreakable ceiling of resistance at the 200-day moving average, and I grow more and more wary of recommending any of them, even the best ones. However, Fitzpatrick believes this downtrend is ending. See, the XLE has actually made a triple bottom here, and that it starts right here. That's one bottom. That's two bottom. Here's the third bottom, all right? And that's where the lows from December of 2018 hold up. At the same time, the consolidation over the past month has occurred at a higher level than the triple bottom pattern. So here's the consolidation. Now, the XLE is headed higher again, setting up another test of this 200-day moving average, and that's the blue line. But this time, we're coming at that test from a much higher level. So rather than just from here, we're coming at it from here. Certainly better launching pad. The bulls want to see a breakout here the same way we got a breakout in the metals ETF last week. Fitzpatrick thinks it may take a while for this to happen. We might be earlier, but it's definitely something you should watch for in the weeks ahead. Now, here's my view. It wouldn't surprise me if he's right. We've seen some very strong action, for instance, in Schlumberger. My Travel Trust owns that one. Halliburton, those are two oil service stocks over the past few months, which suggests that, well, that group may have finally bottomed. Of course, a lot of people have been burned before betting on a turn in energy, though, including me and my Travel Trust, because we own a couple of some real clunkers in this patch. But then you'd have all three sectors going higher, metals, mining, and oil. That's pretty bullish. The bottom line here, the charts as interpreted by Dan Fitzpatrick suggest that the metals and mining and basic materials plays are headed higher. And even the energy cohort might be ready to turn soon. If that's the case, then 2020 could be a very good year for this bull market. Even as, I'm going to tell you point blank, I am not yet a believer in this part of the market. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.